So I wanted to introduce Dr. Laura Rusu from Lenzel and Diversiview, so we can go through and see how this tool works in terms of diversification and how it might be able to help your portfolio. Hi, Laura.
Hello. So what we have on screen is the analysis page. We'll go through it. First, just to say that probably in another video, your users can see how to create a portfolio, actually how to enter the portfolio or to upload from a CSV. So here we have analysis done on one portfolio.
Just before we get started, I just wanted to point out that this is a small part of my portfolio that I'm working on with QAV Investing Podcast, the QAV methodology, and I imported this using ShareSite. I just basically plugged in ShareSite from Diversiview, and this was what populated it.
Yeah, so it creates either you do it from scratch, or if you upload from ShareSite, if you have a ShareSite account, it will create this analysis page, as we call it. Actually, your portfolio universe, again, our name for it, because it has so many angles. So Diversiview, actually, the main goal is to solve the optimal asset allocation problem for investors and retail investors and investment professionals, investment advisors. So we created this software application that allows investors or advisors for their clients to enter a portfolio and then analyze, see where their portfolio sits currently, see if they want to improve anything, and then we have tools to help them optimize the asset allocation to suit their specific risk and return goal.
And so this is based on, you've taken historical data for basically every stock on the Australian share market and looked at the historically. What sort of thing are you actually looking at?
Yeah, so we use the history of share prices returns, because most of the indicators are based on the returns. And we'll see a bit later for correlations, we consider past 10 years of returns to calculate the correlations, where available, of course. And for the portfolio indicators like risk, return, alpha, beta, we use the past 3 years. So 3 years starting, past 3 years until yesterday. So we calculate, again, we'll see a bit later, we calculate some expected portfolio indicators. And that's important because most people, I'm not saying everyone, but most investors consider each investment isolated. Like I invest in A, B, C, and there's just, 4, 3, 5 investments. But all investments will be correlated in some way or another because we are in the same, economy, national economy, global economy. So things get correlated. So we need to look at them all together as a whole, as a portfolio, and how that works for our goal. So if I set a goal for a specific level of return I want to get, how do I know if my investments will help me achieve that goal? And while I go there, will I be sleeping well, or I'll be very anxious? My portfolio is very volatile and goes up and down over time.
Okay, well, look, let's have a look at this portfolio then. So, I think I got a pretty good score, didn't I?
That was the diversification, yeah. So, top of the page, it just shows the asset allocation which you entered or you uploaded from a share site. So I have 7 stocks here.
And this is the first thing. Like if a new user comes to Diversiview and they want to plug in a portfolio, this is basically the first thing that they're going to be introduced to, isn't it?
When you go to Diversiview, you'll see a dashboard like this. Of course, all this analysis will not be here. You'll have a menu and so on, so you can create a new analysis. When you create a new analysis, you have different options here. You either do manually, so we enter your securities, whatever you want.
One by one.
You can enter some weights if you want, or if you have. If not, you just enter a normal, just the security. You can select some custom investments, for example, cash, and you enter your expectation of return for cash and how much in your portfolio is that. Or you can upload from a CSV if you have many securities or many investments. And then you say click on get results, and then you get the page where we are looking. All the analysis you run from your dashboard are free, and we'll see what options you have for some paid features.
Yep.
So this analysis has seven stocks. First section here is performance and benchmark. Here we show the portfolio indicators based on your current allocation. So this allocation here, it calculates portfolio expected return. I'll explain each of them. Portfolio volatility, Sharpe ratio, beta, and alpha. And then the second column is what would be your indicators, these 5 indicators, with an optimized asset allocation. So if you optimize this asset allocation and change the weights a bit, what would be optimized? So in this case, as you can see, the expected return increases quite a bit, 16.01, which means quite a lot for a 200K portfolio is maybe more than 600,000 after 10 years.
The expected return, is that a yearly return that we're talking about
yes,
there?
So it's a yearly return. So portfolio expected return is based on past, as I mentioned, past 3 years of returns. It's a expectation of return is calculated as a compound average of daily returns. So geometric average of daily returns analyzed at the end. So we take daily returns, do the compound, geometric or compound, same thing, average, and that is analyzed. So in current allocation, you have an expectation. Of course, as everyone knows, there is no guarantee, but it's an expectation that you get based on the past data, past history. So 21, 28. Volatility is the standard deviation from that return. So if you have this expectation of 21, 28.28 return, your volatility, it means how much the return may fluctuate in future.
So if I just sat on this portfolio, I could expect it to go up or down by 40% at any particular time.
Yeah, so you can get up to 60, but you can also lose quite because if it goes to, it goes down. So volatility really means, if you imagine like a line is not really a straight line, but just for sake of explanation, if you imagine your return, it's how much goes above that line, below that line. And as we know, prices go up and down every day. So you can only look at one at a time. So this is a sort of calculation how they all would go, how is the expectation to go. Sharpe ratio is a risk-adjusted return. So what it means, you want to see how much return per unit of risk you get. So if you take this risk, what's your return per unit of risk after you deduct the risk-free rate of return? So
so the risk-free rate of return is, of course, just if it was sitting in cash, for example.
That's we use different systems, probably different. We use different risk-free rate of return, but traditionally in US is US Treasury bonds. In Australia, it's Australian bonds, 10 years yield. So what you want to get using this formula of Sharpe is actually want to get a value greater than 1. So you want to, or at least closer to 1 as possible, because that means that you get more return than risk. So you get more return compared with how much risk you take. So you want investors want a value, a ratio greater than 1 here. Portfolio beta is like investment beta, is how volatile is that investment, in this case the entire portfolio, compared with, again, a benchmark. In our case, or in the Diversiview, we use All Ords index, so top 500 Australian stocks as a benchmark. So we say your portfolio here compared with All Ords as a whole is 0.87. So it's close to 1. When it's 1, they have the same volatility. Pretty much they move in the same way. So move with the same speed. Let's say when the market changes, your portfolio and changes quickly after that. So 0.87, it's close to 1. So it's a high value. It means it's pretty much as volatile as the entire market. And portfolio alpha is how much your portfolio is expected to get above that benchmark. So again, if a benchmark is all odds, say if all odds in time will get 3%, again, for the sake of exemplification, your portfolio will get 3.16. So 0.16, it's how much. So again, with alpha, you want a value which is positive. So again, depending on your benchmark, you want to get a bit more than the market, or much more than the market. That's and here you hear about many investments looking at alpha sort of based investing, meaning that they want to maximize that alpha. We want to go above the market with as much as possible, practically in that portfolio. So what we aim to do with Diversiview and for each investors to be able to do is to optimize these indicators. In a sense, you want to increase your return, you want to decrease your volatility, you want to increase your Sharpe ratio, you want to lower your beta. So beta is better if it's lower because it means that your portfolio is a bit more stable than the entire market, and you want to increase alpha.
Yep. So lower beta is better. I like that.
Lower beta is better, higher alpha is better, higher Sharpe ratio, as much as possible over 1, if ideally. So here we just have a few explanation how much is that difference in the optimized. We also added this new, so actually it's a new feature which we will inform users today about it, where you can look at backtesting your strategy. So you had that allocation. How would that behave in the past year? And we can calculate the optimal allocation, which is, we don't know it yet, but it's there, so it's calculated, and with equal allocation. So in your case here, in this portfolio, for example, it looks like the different times, one is higher than the other. So it depends on how the composition went along the year, past 1 year. At some point, this optimal allocation get highest, return, maybe over 110,000. Sometimes the equal allocation gave better return. So again, we don't make any recommendation here. We just leave people to compare their own allocation with what would be the optimal allocation, and I explain what's that, and the equal allocation where just all stocks have the same weight. Now, based on these values above, or this table here, which is the set of 5 indicators, you have this risk and return, as we discussed, 21, 28, and 40.45. And what it means is, this is your position here, the green point on a risk on the x-axis and return on the y-axis. All the other blue points are other positions for your portfolio if you change the weights. So you have seven stocks in this case. You can have, I would say, hundreds of thousands of positions, meaning how you combine with 7. So these blue points are not different stocks. They are different combinations of your stocks giving a risk-return result. So this green point is your position. So it was 21 and something, 28% and 43 and something risk. So as you can see, there are so many other positions. You can have, for example, like here, you have a very high risk, very high volatility for a much lower return. Or you can have here much higher return, this one, but for a high volatility. So what people try to find is, there is a single point where the return is maximized and risk is minimized. That is called optimal portfolio. And if of course you know about, and many listeners or users will know about the famous 60-40, where people say you have to put 60% in stocks, 40% in bonds to get that optimal allocation to balance that risk return. So what happens if you don't have bonds? How do you do that? Is same 60-40? Is not. So there is a point somewhere here where that happens. But there are some other points. So these are the orange points called the efficient frontier, where the return is maximized for the same level of risk. So if you look here for your risk, you can find other positions because there are so many blue points, it looks like a very big shape, but there are many blue points. You can find other points on top of it, which will actually maximize your return, expected return, for the same level of risk. So if you're happy with that level of risk, let's say you don't want to minimize it, don't want to increase it, you are happy with it, you can find our position which gives you, and this is called the efficient frontier. And we can, we have a feature where you select which point here you want to go. Let's say you want to go to this point or this point here, and we'll calculate the combination of stocks which take you there. And really behind it's a lot of mathematics and optimization. Now, there is another point which is very important, and many people use it. So I know from discussions with many investment professionals that they are sort of advised to look with their more conservative clients to the minimum risk portfolio. And that's the portfolio which is sort of at the leftmost position, where the risk is minimized totally. No matter how much is the return, is the position with lowest risk. And again, we can.
And so, does that risk, is that the volatility? Is that a reflection of how much it's going to go up and down over a period of time?
So if you are a conservative investor, you want to say, I want to have the least amount of volatility, smallest moves up and down, so I can sleep well at night. I want to go to the left position. And what's the combination of stocks? Or if you are very risk taker, you go somewhere else. You say, I'm happy with this position here. It will give me almost 60% return, expected return for 100 and something volatility. So I can take that volatility. I can sleep well at night, but I want to get that big return, potential return.
This is something that I've been really thinking about a lot lately. It's the different ways that people think about risk and volatility, because people in financial services, they talk about risk as in volatility, as in how much it's going to go up and down. Whereas a normal investor, most of them think about risk as how much money am I going to lose? They're kind of at odds with each other, and this kind of seems to be, I would say, explaining and maximizing. Go on.
I would say that in a way it's the same thing. Just people. Sorry, I moved. Of course, people who don't have a financial education is not their fault. Of course, you think about how much money can I lose with my investments, but actually that loss comes from the investments going down. So that volatility, the going down of the investments is part of normal going up and going down. No investment will stay the course, even, cash will be subject to inflation, so it will change. So, but investments, and it's known that, stocks, especially most popular stock, will be subject to, more volatility because more people will buy and sell into it. It's a psychology behind as well. And during crisis, many people sell, their fear of loss, and they sell, and of course the price is lower. So the fear of loss, the risk of loss, is part of the volatility. So by knowing the volatility, you know how much exposed you are to have a loss. Again, potential. You could be lucky and get on the upside, but in long term, there is no way. Very few cases when it just goes smoothly up with a very low volatility. In most cases, we'll have some volatility, so you have some losses. Now, it depends on how big those losses are. If you have a low level of volatility, it means you may have a lower loss, or a smaller loss, sorry. If you have a high volatility, you might have a bigger loss. So this is why it's important to know these things. It's not that you can control the market. Of course, you cannot control the market, but you know where you are. You know what to expect. And if you're lucky, you get much better, but not everyone is. So, so with this figure, which looks complicated, but it's actually where you are now compared with what other potential positions are there for your set of investments, not for everybody else.
So basically that orange line that we can see on the screen, it's basically showing the lowest risk to the highest risk, and how your rate of return is going to be affected by taking more or less risk. Yeah. Okay. Yeah, that makes sense.
And so first here we have a high-level asset allocation. It's really because you have this, granular asset allocation here, where you have percentages, And what we
Yep.
calculate with Optimize is like granular at investment level, but we also have this high level asset allocation, which people have in many other platforms. Yeah.
Yep.
So it's somewhere. So this is a high level view, and I'm saying it is good, but it's not enough. You need to go and look deeper and what's same with diversification. So here your score was quite high, 4.8 out of 5. So 5 being the portfolio
Perfect. Yep.
perfect diversification, a sense of perfect meaning you don't have strong strong positive correlations. And here is again a longer discussion. When two stocks are correlated, it means their returns move in the same way, up or down.
Okay, so it's nothing to do with correlation in terms of the industry that they're in or how they're covered. It's how they move.
It's how their returns move together. And usually in the same industry will be a level of correlation. So if you say, for example, you put BHP, Rio Tinto, or two banks, they will have very big correlation, but doesn't mean the correlations between all stocks in the same industry are all the same. BHP Tinto could be something, Fortescue could be something. The same between banks and also between those stocks from those industries and other industries. It could be a high level of correlations because of some business or operational reasons. So you don't know unless you look inside. And again, that high level of asset allocation at the different industry groups here on the left. So you have 5 sectors here, which is good, but you don't know if you could have 4, you could have 6. But just looking at how many sectors you have doesn't really tell you about this diversification rating. And here so if 5 is the best one, we penalize the strongest correlation, which you don't have here, which is strong positive correlation over 0.5. So here these green lines show very, very low correlation, 0.0, and it's almost 0, which is almost no correlation. Or you have minus 0.8, so you have some negative here. You can use these filters to look at them.
Oh, okay. Yep.
Some negative here between some more resources and Hela Group, which is banks. This is so. Again, there is no way of saying how much would be the correlation between, unless you look at the individual pairs, not just say, well, these are 2 different sectors, and it means they're not correlated. So you have these filters where you can look at different things, see, for example, what are the positive correlations. What most people are interested in is this strong positive correlation, because if you have 2 stocks which are very, strongly correlated, 0.8 or 0.9 sometime, so you cannot, you don't see one too often, but very high correlations you can find. And that means that they go together, up or down. Their returns go together, up or down. So if you have, let's say, $10,000 in 2 stocks which are very strongly correlated, it means you actually, you have 10,000 in each, it means you have 20,000 in just one. They will behave together. So you should consider this. And that's important. All these numbers here, these correlations, why are they important? They are important in calculating the volatility. So again,
how much they're going to go up and down over time.
How much they're going down. So the expected return is quite easy to calculate, let's say, in Excel. So you have returns of each expected returns for each investment, and you do a weighted average, which is easy to do. For volatility, it's much more difficult because you need the volatility for each investment. You need weights, of course, you have it,
and that's based on historical data. Is it?
3 years past. And you also need all those correlations. And if you have 2 stocks, it's easier. You have just correlation between them. If you have 3 stocks, again, it's easy. As you go to 3, 4, 5 more stocks in your portfolio, it becomes really very complicated to do it. You can do it, but you have to be very patient. You have to have all the data in Excel by yourself. And if you do that, you end up with this position here, blue, but you don't know all the other potential positions. I would say...
So at the moment, mine is not the optimal risk or
yours
reward.
Yours is not optimal. So I would say you do, a few things. you could look for the minimum one if you want to take a lowest risk. And we have here these features here to calculate. So we can calculate the optimal portfolio, which gives a maximum for the minimum risk. You can calculate the minimum risk portfolio, as I mentioned, the leftmost, or you can find these efficient frontier positions. So let's look at this one if you want. Let's find this position here. Let's say we want to have like 40% return for somewhere, I think will be 50 something risk. And what will this feature is a paid feature, and Diversiview has a credit point system where you can buy credit points to do this. So let's say we select, you can drag this to different levels of risk volatility, and it will show us underneath here what's the expectation. So let's say we go to the...
So we're going along the orange line.
You go along but blue, yeah. So this efficient positions is the orange, sorry, not blue, the orange dots. So let's find...
sorry, okay, yep.
Yeah, so let's see, we had the expected return 20.28, I think, 21.28. So we want to increase that, let's say, to 36, and we're happy with this 46. It's closer. You see, it's 10% difference between your return and your volatility. So let's say we're happy. So I'm just to exemplify how it goes. So this is a position we calculated, and these are the weights calculated for this position, and let's see what it is. So it was here.
Oh, okay. Yeah.
We picked this point. We could, pick another one, but so we picked this point, and so it gave us the position which increased our expected return to 46. The other one is also 40-something%.
Yeah, it was around in the 40s. Yeah.
So increase the position while decrease the volatility. It was 43.
Okay.
Remember, 43. So now it's here. So it decreased a bit the risk and increased the return. So that's the idea. You can look at different positions where you want to be for your own set of investments. We cannot say that a specific allocation is best for you, Phil, or for me, Laura, or for anyone. You need to find what you want to have in terms of risk and return. So the thing is to find what you want. So with these features which we have here, with capabilities, we actually help people, as I said, to actually calculate that optimal portfolio, to calculate the minimum risk or efficient, or there is another feature where you analyze with your preferred returns. Again, this is 10 credit points. The idea is that you may have some, not preferences, but some other expectation of your returns for a stock, for a company, based on some other analysis that you've done, or based on some other information that you have. So, for example, you believe that this stock may not have a negative return, but they may recover and go 10% in future due to some business changes they make, or some other information you have. So you can recalculate all this with your preferred returns. So let's say this will be for 30 or 40, or again, just exemplification, 5, and recalculate. So in the new analysis, we will use these returns which you entered, your expectation, but we still calculate volatility based on the past behavior. So here you see the order type was manually set return, so it tells you how much. And again, you had we use minimum maximum constraints 199, and this is the allocation which. This is the result of that analysis. Based on that allocation, with your expected returns, the stock will be somewhere here. Is still on an efficient frontier, but you used your expected returns. And
you mentioned credits, and people can do some of this sort of thing for free. How much do credits cost?
So. As I mentioned at the beginning, it's free to run the analysis. So this analysis page, when you enter your portfolio or upload, it's free. So you can look at this performance, you can look at this risk return position, you can look at your deep diversification and see in between. And then those four buttons, four features are paid with credit points. So the calculation of minimum risk, portfolio, optimal portfolio positions, and manual returns, preferred returns. Those are paid with points. Currently, they are each 10 credit points. And to get points, there are two options. You can either buy a package which has 200 points expiring in 1 year. So you can run optimization whenever you want, if it's February, March, April, whenever. Or if you are a professional or you use more often for your own portfolios, you can have a subscriptions. The package is 169, so for 200 points. Subscription is 89 per month for 100 points. So those 100 points will expire every month, and you'll have new 100 points every month. Again, depends on the situation for each. We have users who have, packages, and they have a freedom to run whenever they want, or if they do it more often, they get a subscription.
Fantastic. Okay, I think that's a great explanation, Laura. I understand it a lot better now than I did before.
Yes, and we also plan to have much, expanded user manual on our blog, working on that to have more explanation about each of these points, which probably some of them need a bit more explanation than we had time today. But we aim to have a more expanded manual for people to go and have a look, and they also can ask questions, send us a message, and we can help to get these points clearer, because I understand that some of these are quite complex. We try to make them as easy to understand as possible, but they are still complex. At the same time, they are very helpful. So once you take a bit of time to understand what it's all about, it could be very, very useful for your long-term portfolio and investment strategy.
So my only other question is, with my 4.8 out of 5 for diversification score, does that qualify for a gold star?
Yes, it does. So we actually, that's very good for you to have this high diversification rating, because it means that the stocks you picked are diversified. So what you need to work on now is to improve this position, to increase your return, reduce your risk. But some other people will find themselves in a position where the deep diversification is quite low, the rating is quite low, meaning that they have many strong correlations. So again, we don't give advice. We don't tell people you have to drop that or buy.
You're not saying what to buy,
No, but what we help them to see is where those strong correlations are. As I said, if you have two very strong correlative, they go together. So it's like having money in one instead of two. So you need to think about yourself and look at those very strong correlations, which will show in bright red in the diagram, and that will give you a hint where you could look to make some changes, to say, more let's say politically correct, to make some changes, to have stocks or investments which are not correlated or which are negatively correlated. Because if we come back to the research and we say that we haven't invented it, it's based on Markowitz's modern portfolio theory, and Markowitz said that the most efficient portfolio is the one where you have good investments, of course, with good expectation of returns. Nobody wants to invest in bad investments. So good investments that are not correlated with each other or that are negatively correlated. Because that combination, that particular scenario will help you to have a good total return at a low risk. And you'll hear people say, well, I'm happy to take, high risk, I want high returns. It's okay. And, probably younger people will say that more often, but could be anyone. But that doesn't mean that you cannot have high level of returns at low risks. So you fit, you fit both things at once. You don't need to go one way here and having very high risk, very high returns, or going here where you have very high risk, very low returns. There are so many places where you can be. So again, it comes back to you to figure out, and this is what we offer, this support for people to calculate the best for them. We don't want to be a robot advisor. I never want to, although I trust I can create the technology to be a robot advisor, but I don't want, because I think people need to take their own decisions, and they have to have more information for that. Nobody should tell them buy that or invest in that particular portfolio. They should be able to calculate themselves. As I said, if you take a bit of time to understand, that could be very powerful, because knowledge is power. So you need to know more about your investments to invest smarter and better.
Laura, thanks very much. That's been great.
Thank you very much, Phil.